Hello and welcome to this special edition of Suits and Boots, the TDI podcast series, in conjunction with Resourcing Tomorrow. In this series, speakers at this year's Resourcing Tomorrow event discuss some of the key themes that will be covered at the conference. I'm Assheton Carter, Executive Chair at TDI Sustainability and your host for today. So today, we're getting into one of the most pressing topics in the industry: how to unlock capital, accelerate development timelines, and build strong partnerships with financiers that drive responsible mining and long-term value. As the global demand for critical minerals accelerates, the relationships between businesses along phases of supply chains have become closer, I would say, or even systemic. They're more interested in how minerals flow and the nature of offtake agreements and for value creation along the whole trading chain. With this, we've also seen the need for innovative, efficient and responsible financing modalities to support sustainable mining development. This is what we'll discuss today. In particular, we're going to explore strategies to attract investment across the mining life cycle, deal flow, from exploration to production. How regulatory and ESG, yes, it does still exist, trends are reshaping risk perception, and the financing modalities that are helping projects overcome traditional barriers to access capital and meet their production projections responsibly. I am delighted today to be joined by someone with deep expertise in these topics, Sylvain Eckert, partner at Infravia Capital Partners, a leading European private equity firm focused on infrastructure, technology, and critical minerals. With more than 20 years in metals and mining, including his previous role as head of the metals and mining team at Natixis Global, Sylvain brings a wealth of insight into capital markets, mining finance, and the future of resource development. His passion for rocks, metals, and responsible commodity production makes him an ideal guest for today's conversation. Welcome, Sylvain, and thank you for joining us today.
Thank you for having me, Assheton.
Good. Well, I thought we'd start on setting the scene. So I want to start the conversation with your view on the big picture, the general picture around investment in mining. How are the investors' attitudes towards mining? They're prioritized in terms of projects and minerals and the risk appetite evolving for investment, especially in light of the global energy transition and the critical minerals race. A couple of years ago, the number of private equity firms, for example, and corporate investors into mining was really kind of quite small, and I thought it was sort of dwindling, certainly in Western markets. But now there are more. So what's happening?
So it goes without saying that everyone understands that tomorrow is electric. Actually, today is already electric, but tomorrow even more. And more electricity leads to more metals consumption overall. Just to produce electricity and to be able to store it and transport it, etc., etc. And for the past 2-3 years, we have seen noticeable changes in the approach of some investors to the sector, especially in the European Union. The mining and metal sector is essentially a sector that has been abandoned by Europe some 4 decades ago. In some countries it was more acute than in others, and it's been capital starved ever since, especially. And we've discussed with a lot of European investors, and we spent a lot of time to educate the investor base in France and in Europe on the sector. And what we've seen recently is a dramatic shift in the approach, because we started to receive inbound interest for the sector for the past years or so. There's no debate that one needs more metal. People understand that. Everyone understands the rationale of setting up a fund to invest into the critical metals value chain. But for those investors in EU specifically, this is something new, and that is difficult to apprehend. And but what we've seen is that we're past beyond the debate whether this was warranted or not, and we're seeing people trying to figure out how they could fit that specific asset class in the strategy. And I mentioned it's not an asset class per se at the moment because there's not enough player, but there will be more, and we strongly believe that this will become an asset class on its own, like the infrastructure space evolved over the past 20 years.
Great. So you said that it is a specialist field, isn't it? I mean, I've been working in minerals and metals for 30 years, and the world is quite small. And I think that's one thing that gave investors caution because they felt they couldn't understand it. So it sounds like you had to do quite a lot of education to explain how the system works. But as I understand it, the Infravia isn't just investing in critical minerals, it's investing in the whole value chain where it can, in the technology and the infrastructure as well. Can you tell us a little bit about your vision for this strategy and how it's positioned to respond to the evolving needs for both investors and the energy transition? What makes it a bit different from traditional mining investment modalities?
Yeah, so you rightfully said that Infravia not only invests into critical metals, actually at the inception, Infravia is an infrastructure fund, an infrastructure strategy, and that's the locomotive and the flagship for Infravia. We made an investment a few years ago in a company recycling bottom ash from incinerators and producing metals, and that was the first foray of Infravia into the metal space. But really, the idea or the thinking was that in order to build all those infrastructures and all the energy, all the data centers, etc., this is going to be metal intensive, and it makes a lot of sense then to move into and deploy and set up a strategy specifically dedicated to critical metal. So we do in that critical metal strategy, we invest across the value chain. So from extraction, refining, and recycling globally across the planet. I will probably say it a few times on that interview, but you don't negotiate with the geology. The good deposits are where they are, and you have to scout for them. The scope of our investment is the critical raw materials list of the EU. So typically doesn't include precious metals. It's got 34 metals. Some of them are relatively liquid and easy. Some of them are more niche and small market. We are a 25 years fund, so we are patient capital. We have the time to build mine. We are not inactive or passive investors. We will accompany the development of the asset that we invest in to build platforms, to develop new mines, new refining capabilities in the critical metal space. We actually, one conviction that we have is that investing into the critical metal space, despite the impact of those additional mines, is a net benefit for the planet, because all of the mines that we'll invest in, all the refining capacity, the recycling capacity, everything that we'll invest in will ultimately displace coal, and overall the impact on the planet is going to be a net positive. We have also quite a unique setup where we have money from the French government, yet we are a fully private fund with fully private governance. So the government has no say into our investment decision. We're managing its money, and that's all. The idea of the French government actually was quite smart. It was, we are seeding that strategy with public money, but we expect private capital to be raised alongside the money that we're injecting into that strategy. And the manager, so ourselves, Infravia, its duty is to deliver performance to attract more capital into a capital-starved industry. So our primary goal is to deliver performance for client, including the French government, but also our private client, and accompany the projects that are above all profitable, best in class in terms of the ESG, and provide a benefit to the European industry.
That's great to hear about the patient investing. You know, if I look at where the processing capacity is and the recycling capacity, that's not yet really in the OECD countries, but is kind of highly concentrated in China. So you really are looking at a long-term play to build that capacity, I guess, outside of those regions. So does that affect the expectations for, cash flow and returns and building returns into the fund?
No, so as I said, our primary goal is to deliver performance to our investors, right? Mm-hmm. And that's a very necessary conditions to be able to attract the amount of capital that is required to develop the sector. If we don't do that, we'll have less capital and we'll have less capabilities to develop the sectors and to provide options for the downstream industries. Because as you mentioned, the fact that these industries at the moment are highly concentrated basically poses a risk, systemic risk to the rest of the downstream players and to the consumer. So it's important to be able to build alternative optionality, resiliency into this value chain, but not at the expense of performance. So we're a long-term fund. We are looking for good and resilient assets, above all, that will be profitable and performing well. So it's a complicated and long process to screen all of the assets, determine which are the better one, which are the ones that deserve to be invested in order to build those value chain and build resilience and optionality for the end consumers.
And another complicated aspect of your world is the ESG, sustainability and traceability aspects. Even though the EU is looking to make that a bit easier for business, it's quite a sticky trend that more and more ESG safeguards are expected, and you're dealing not with one sector but with several. And also, a lot of those ESG standards now require traceability to kind of point of origin. So, are you looking at how you can build whole systems, or are you looking more kind of fractionally at different segments? And how do these ESG standards, expectations, and the traceability pieces play into your decision making?
Yeah, so I'll start with the integrated versus non-integrated part of your question. The idea for us is to build systems. The question is, can we do that in parallel, or does it have to be sequential? And I'll come back to that a bit later. In terms of ESG, we've designed a framework that is quite comprehensive. It's based on the applicable standards, but we go a bit beyond that. And this is something that obviously we have been discussing with our investors. It was quite key to give confidence to our investors that the perception that they had of the sector would be addressed by the fact that they would be investing in someone that would do things properly and methodically from that perspective. So it encompasses obviously all the duty of care when it comes to making sure that we are monitoring what happens in terms of where we're sourcing feedstock from for refining assets and et cetera, which brings me to the sequential versus parallel aspect of the questions. At the moment, effectively, the bottleneck in those value chain is mostly through the refining. But what we found out during the past year of scouting assets, et cetera, is that it's quite challenging at the moment to build a standalone refinery in Europe if you can't agree with mining producers to get the feedstock, and if you can't agree with the clients to secure a long-term offtake. So the approach that we are taking at the moment is do things sequentially, meaning we are focusing first on securing metals unit from mining assets, so extraction, and then that should completely unlock the refining part. Having secured metal units will allow for refinery to be built, and then to develop a complete system. And that also addresses the issue, which is not an issue, but that addresses the traceability aspect. We will have a vision through the value chain throughout our investments.
Yeah, that makes perfect sense. Get hold of the commodity first, get hold of the metals, and then figure out how it's going to be transformed. And maybe there's some other regions as well, such as the Middle East, that could play a part in the value chain. Just going back to mining for a minute, one of the kind of the most difficult things, it seems, as long as I've been doing this, is for juniors to raise money. And I spent quite a lot of my time in Africa and speaking to junior miners there, and they're obviously always on the hunt for capital and capital raise, and they find it more and more difficult. And there's very few funds. EBRD does it from a DFI point of view, which invests into juniors, but not many others. And so they tend to look towards China. What can organizations like you do for these these entrepreneurs, early stage risk takers, to make their life easier and get more control of some of these minerals?
Yeah, so unfortunately, we won't be the solution for them because our thesis of investment is to deploy meaningful amount of capital to enable production. So we're investing more after the feasibility study is released. But that's actually a point that has been raised a number of times and for which there's no simple solution. That said, there is at the moment a large stock of projects that have identified resources, that have made a scoping study, or that have been identified. And the issue for me is less for this junior to find money to finance more exploration, but is actually how do you progress a project through the PFS or BFS stage. Typically, a BFS will cost back of the envelope 10% of the overall contemplated capex. So if your project and critical minerals project, it's not unusual to have capex which are order of magnitude 1 billion type thing. That means that you need to spend, give or take, in excess of 50 million, between 50 million and 100 million on a feasibility study. So where do you find that money? That is the question. That actually one of the areas that the EU is contemplating to investigate. As you mentioned, the EBRD does it. There are other toolbox within the EU to try and speed up and enable those projects to get access to funding. That being said, good project, outstanding project, when you don't negotiate with the urgency, when a good project is identified, generally has no problem finding adequate funding mechanism and will attract investors no matter what. The issue is that there's a lot of projects that are not super outstanding, that are average, that are decent, etc., etc., etc. And how do you progress those projects so that they are readily investable and ready to be put into production when they are required, when the mining cycle calls them upon. And at the moment, it's difficult because we're facing an oversupply situation in most of the critical metals, which doesn't help with mobilizing investment.
Got it. So focus on quality, focus on the fundamentals, and the rest should follow. But something you said there about there are some other organizations which are looking at that earlier stage. And I guess from my perspective or from some people's perspective, that means there's an opportunity for partnership where you can bring different things to mineral development. What do you think about kind of partnerships? There's a lot of talk about public-private partnerships, but they're not straightforward. They're quite hard to put together when you have different theses and different ways of working. But do you think there's room for groups like Infravia to work with some of the DFIs or some other funding mechanisms and modalities to reach your goals?
Yeah, no, certainly. I mean, we are quite flexible when it comes to finding solutions to fast track and develop projects. Obviously, we have money from a public institution, so from the French government. We've been discussing a lot within the EU and the various tools in the EU toolbox. There are other in the French government, other means of funding critical raw materials projects that are available and that will rely mainly on public funding. The other EU governments have also initiative, which obviously we've engaged with and we're ready to partner with. I mean, if that makes sense, you could bring the funds from different EU governments in order to deploy more effectively and fast track the development of those critical minerals projects. And when you go to outside of Europe in jurisdictions where there's less appetite, obviously relying on DFIs is something that has proven to be extremely powerful. I'm an ex-banker, so I used to work with notably the IFC in countries where the financing that were put in place enabled very significant industrial developments. So yes, that's certainly something that's on the table and something that we are looking at when we're considering an investment, either on the equity front but also on the project financing front.
But I think your kind of point earlier on was that in the end of the day, Infravia it doesn't have constraints placed on it by the government and the French government in this case, and it is privately run. And I guess what you're saying there is that, the fund isn't there to advance industrial strategy of any particular country. You're there to invest and get the return that is expected by
we are here to make sure that the capital gets attracted by the sector and that more capital will flow into the sector because it's a profitable sector, and basically more capital means more optionality, more resilience, and overall something better off for the end users, the consumers. Beyond myself, when we're buying an electric car.
Absolutely. And so just going back to these partnerships or the interest in the public sector generally, and your experience over the last couple of decades, have you seen some more innovative modalities for minerals and metals, green bonds or royalty financing, streaming, blended finance, all these type of things, or has it remained quite constant?
There's constant innovation in the sector, and people do get creative quite in quite a number of ways. Obviously, some it's not new anymore, but royalties and streams were something that developed quite a lot over the past decades, probably even a couple of decades now. So that's been quite innovative. That has become mainstream. That's a super useful tool to have in the toolbox. Offtake financing is something that's also quite attractive, and we've seen obviously large traders, but also OEMs, automakers, entering into being capable of financing project and capex through that mechanism. You mentioned green bonds, and that's something that the sector has not used, or at least the new projects have not used extensively for the time being, but that could be something that ramp up in the next while. There are some areas where the bond market is quite developed. I mean, typically the Nordic bond market is quite interesting for the sectors if your project qualifies and have the proper characteristic to be able to raise money on those markets. And we've seen recently some issuance of convertible notes for project developers in the uranium space, notably. So all these less dilutive instruments compared to the traditional equity are something that is very useful and that we'll look into when we're considering our investment. One important thing that I think the sector needs to address in terms of innovation is around price discovery and price risk mitigation when it comes to critical raw materials. There's very few of those critical metals that are listed on exchanges such as the LME. There are some areas where there's question about the price discovery itself, and price risk mitigation mechanism to stabilize the cash flow one way or another could have a drastic impact on the appetite from lenders or from debt finance to enter into the sector. So there's a trade-off between availability of liquidity and tools to stabilize the cash flow and mitigating the price risk, essentially.
Yeah, I think that's a very important point, actually. I think that's kind of really clear that, there aren't exchanges for many of these minerals. So that adds an extra complexity. Something just kind of came to mind when you're talking about the innovative models and how that's, people are quick to respond. I'm not sure if it's a trend, but there's, a few downstream companies, and I'm thinking of Cobalt with the K, for example, who have actually invested upstream into mines. And I guess you could say, going back to the last century, this is what downstream companies used to do to try and control the supply chains. Do you see that as a thing, that you have some of these auto companies or downstream companies beginning to invest? I remember the former CEO of Glencore saying, "Welcome that auto companies invest into mining."
Yeah, no, that's quite interesting, and certainly that's something that's not unheard of, but that was kind of that's way back at the beginning of the century, etc. Actually, this is something that it should be carefully considered, because on one hand, you could argue that these companies do not necessarily have the skill set to make the right selection in terms of assets and what they actually need to vertically integrate. But at the same time, there is a need for more vertical integration, because in the Western world, if you are separating too much the various parts of the value chain, you end up with something that is very flexible but somewhat inefficient. So, as I was saying, the idea for us is to develop platforms that have a certain level of vertical integration, the boundary of which can be discussed. But it would make sense for miners to integrate downstream to some extent to be able to serve their customers with the materials that they need, and for the end users to integrate upstream to make sure that they are controlling and that optionality in terms of their supply. So, at which point do they meet is a question that can be debated at length. But certainly, this is something that we do see developing more in the coming years in order to foster the development of those value chains.
And I guess that another consideration in such a scenario is expectations about exit, where the downstream might be looking to secure surety of supply in the long term, when if you're an investor, obviously there's some point which you'll want to exit. So how do you manage those potentially dueling expectations?
Yeah. So that's why we have a 25 years fund to be able to exit at the appropriate time. I'm not saying we are not looking for exit. We will be looking for exit, but we are also cognizant that we need time and flexibility when it comes to that. What we believe is that if more capital is brought to the sector, more liquidity will develop, an asset class will develop, and the tradable asset or the trade-off asset will increase, making it just a virtuous circle of capital flowing into the sector and assets being capable of rotate like they do in other asset classes. That's essentially it. The amount of capital that is required to meet the goals of the energy transition are so important that there's no way that these sectors can be developed without more capital flowing into it and more liquidity and more tradable assets becoming the norm.
Another thing which came to mind when we were talking about innovation and now exit is there's a really interesting report, which I'm sure you've seen, came out a few months ago, and I've been speaking to the team at BNP about it, which is looking at the decommissioning liabilities and how they factor that into their decisions. And we're doing some work at the moment for Mining 2030 on legacy. So I guess there's a couple of questions there. Do you look at those potential decommissioning legacy and in your decisions? And the other thing that BNP has said they're now considering is, are there some innovative models such as bonds for closure and decommissioning, which for the underlying assets, for which could be the development of alternative infrastructure where a mine once was?
Yeah, no, super interesting and interesting question. So from our standpoint, our ESG framework, our due diligence framework, and the way we operate is such that we are planning for closures when we invest. I mean, we won't invest into an asset when we don't know how it's going to be run and how it's going to be closed, and make sure that we have visibility on that at inception. When it comes to legacy site, and when it comes to wastes more generally, today's waste may be tomorrow's resources, and we've seen that in the sector in a number of occasions, with waste piles being reworked a number of time and disposed more properly after some more value had been extracted from there. Actually, one of the success of the China industrialization and development of critical metal value chain was their capability to have a waste stream becoming the resource of another industry. That's evident for the LFP supply chain development, where waste from the titanium pigment industry becomes a feedstock for the LFP batteries. That's also evident for the sodium sulfate issue, which is something that is somewhat, not in all cases, but in some cases, a resource or a feedstock for other industries in China, whereas in Europe, this is a liability and the cost of disposal. So thinking about waste as potential resources for the future is something important, and that needs to be considered. When it comes to old mining sites, yeah, obviously the grades, especially in Europe, the grades of the ore bodies that were mined decades ago is such that there's potential to extract more minerals from those waste piles, and in some instances there's probably possibility to extract some of the niche metals that I was referring to in the list of the 34 metals from the European Union, like gallium, germanium, and those kind of things. There surely are resources of those metals in the tailings dump of Western Europe.
That's a nice segue to another kind of related topic, which is about the local license to operate and building trust with communities around new mineral development. And we talked about ESG safeguard standards, and that's more to do with what happens inside the fence. And what's an acceptable standard. But the criticism often leveled at mining is that the promise of jobs and development is seldom fulfilled, at least not locally. And that, I think, is becoming even harder as we get automation at mines too. And that can translate into resistance and difficulties in getting license to operate. And, for sure that can become very stark disparity when you go to emerging markets, but it's also happening inside the OECD. Witness what's happened at the Yadar mine, although there are special circumstances there. So I guess there's an ambition here to invest into more mines, bring more capital, look at the fundamentals. But how about the investment to ensuring that we can win local license to operate, so we can actually get those minerals out of the ground? And how do we go about doing that? Is that partnerships? Because mining companies dig holes, transform metals, and get them to market. They're not development agencies. What are your thoughts about that and how we resolve it?
So I think that the social license to operate and getting more capital into the sectors are actually two facets of the same issue, which is largely the reputation or the bad reputation that the sector has notably in the Western world. As I said, mining was essentially abandoned in Europe 40 years ago, 1984 or 1985, with some nuances, but that's essentially around that date that a number of governments decided to close their mining operations. And the most of the people at the moment, including the investors, do think as mines as something that is dirty, dangerous, like pretty much it was. I mean, there's a famous novel in French called Germinal, which depicts the work at the underground coal mines when on or about the time that there was a Courier tragedy, which was the worst mining accident in France in the early 20th century. And people would read that at school and have the mind that would have in their mind that a mine is something that's intrinsically bad. So getting the social license is also about depicting the sector in another way. So that's that broad perspective that the sector is actually something, as you mentioned, automation, etc., etc. People do not realize that today's you could operate a scoop tram in an underground mine from your office in Paris. That's stretching it a little bit, but that's within the realm of possibility. So there's a lot of work to be done on that image of the sector more globally. Specifically, when it comes to projects that want to get developed, the way to do is always the same. Start engagement early. It's never too early to start engaging with local communities and administration. Tell them what you want to do. Say what you do and do what you say. Consistency is key to build long-term trust. Get some people of the community on board and have them in charge of your engagement with the community. And above all, be transparent. Provide facts, provide data, continuously engage with local stakeholders, and don't hesitate to communicate. You don't communicate too much. You have to set up a robust communication system in place and also a grievance mechanism so that people can raise their concerns. That's how, from a very broad perspective and very specific perspective, I think one should acquire that social license to operate.
Great. Coming almost to the end of the session now. To close this session, I want to play a little word and response game. And what we do here is I'll give you a couple of words, and then whatever comes to mind in a sentence, you respond. So the first one of those is critical minerals.
Everyone's got a different definition of what's a critical mineral.
Good. The next one is responsible mining.
It exists. It's a reality today, and we should communicate more on that fact.
I love that response. That's a great response. And the last one to finish the session: circularity.
The future of mining.
Also a great response. Look, Sylvain, thanks very much for the time you spent with us today. It's been absolutely fascinating. I'm really looking forward now to the session and meeting you again at the Resourcing Tomorrow conference later. For our audience, please check out the rest of this special series Resourcing Tomorrow podcast on the TDI Suits and Boots podcast channel. We hope to see you all at this year's event, where the conversation on financing, investing, and fast-tracking mining projects will be continued. And you can hear more on today's topic from Sylvain. Thanks for listening.